What's up guys, welcome to another episode of Real Life CFA. In this series, we're going to talk about all the important concepts in the CFA curriculum. So the topic for today is the risk-free rate. As always, let's start with the definition. What is risk-free rate? The risk-free rate is the theoretical rate of return of an investment with zero risk. Now, what is a risk? You can think of risk as the uncertainty that you'll get a different return from your expected return. For example, if your expected return for this investment is 10%, but the actual return you get is only 3%, then that's risk. Why is it theoretical? Because no investment is risk-free. For example, if you buy a 10-year Apple bond, which yields 3%, but the company can default, that's risk. If you buy stocks, it's even more obvious. The uncertainty in investing in stocks is very high. What about governments? Governments can also default. For example, Russia has defaulted on its debt. Argentina has also defaulted on its debt. Of course, those are a while ago, but still. It tells you that government is not risk-free. So that's why no investment is risk-free. But government bond yield is the closest approximation that we can get to risk-free rates. Because governments, they can always print money to pay off their debts. For example, if the US government is having trouble keeping up with its debt payment, then the Federal Reserve can always print more money to help the US government to pay off its debt. But you need to be careful here. A government can only print money to pay off the debt that's denominated in its local currency. For example, if a non-US country holds a lot of US dollar denominated debt and they're having problem paying it off, they cannot pay it off by printing money, because the more money they print, the more devaluation they'll get for their local currency against the dollar. So they'll never be able to keep up with the debt payment. That is actually one of the main reasons for emerging countries to run into debt problems. So what does risk-free rate look like? Let's use the United States as our example here. Here's a table with some of the US Treasury yields: 2-year, 3-year, 5-year, 7-year, 10-year, 20-year, and 30-year. Of course, there are more. There are 3 months, 6 months. For simplicity reason, let's just use this table. And these numbers are not updated. You can always find the most updated numbers on the Treasury Department website. Now, if you plot these numbers and connect those dots, you get the yield curve. If you want to learn more about the yield curve, please click the link above. This basically represents the US risk-free rate. Now you may notice that risk-free rates are actually different across different countries. Why is that? We can find the answer by looking at the formula to help us to calculate risk-free rate. You have to take expected inflation into consideration when calculating risk-free rate for a country. And we all know that inflations are different in every country. For example, US right now has a higher inflation than Japan. Then it's reasonable to expect that the US risk-free rate is higher than the Japanese risk-free rate. So how do we actually use risk-free rate in real life? Risk-free rate plays a very, very important role in the investment field. First of all, it can be used as the benchmark rates. You can use these rates to compare with other investments. For example, if a 5-year Apple bond yields 3% and 5-year US Treasury bill yields 5%, then you know there's something wrong. Because the default risk of Apple is higher than the US government. Then why is their bond yielding less than the US Treasury bill? It doesn't really make sense, right? So when this happens, a lot of traders will go into the market and short Apple bond and long US Treasuries because they think that the spread will eventually turn positive, so the market will correct itself. Risk-free rates can also be used to value other type of bonds, such as corporate bonds or municipality bonds. As we mentioned in our bond pricing video, if you would like to check that out, please click the link above. Corporate bonds are usually priced on top of the risk-free rates, which is risk-free rate plus a risk premium. This is how we value corporate bonds. So the risk-free rate is the foundation of bond valuation. We can also use risk-free rate to get a discount rate for our equity valuation models, DCF, discounted cash flow. The higher the risk-free rate, the higher the discount rate. The higher the discount rate, the lower the equity value. Last but not least, risk-free rate also plays a very important role in pricing derivatives such as options and swaps. If you look at those pricing models, you will notice there's always a risk-free rate factor in those models. This is what I mean by risk-free rate is the foundation of our investments. So guys, if you want to learn how to value investments, or if you're students who want to get into the financial industry, please pay attention to risk-free rates. I know it may sound boring, but it's one of the most important concepts that you have to understand in order to get everything else right. If you have any questions on this topic, or have anything that you want us to talk about in our future videos, please leave a comment down below. If you enjoyed our videos, please subscribe and smash the like button. You can also follow us on Twitter or visit our website at www.ironhawkresearch.com. We'll be posting weekly market commentary and article about things that you might want to know in finance. Thank you very much for watching and see you next time.